You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/The Options Insider, or via questions@theoptionsinsider.com.
Regulatory environment impact the future of our industry. Manisha Kimmel is the moderator. She's the Chief Regulatory Officer of Wealth Management at Thomson Reuters. Previously, she served as Managing Director of the Financial Information Forum. In addition, Manisha is a member of the SEC's Equity Market Structure Advisory Committee and chairs its Customer Issues Subcommittee. She's also on the Consolidated Audit Trail Development Advisory Group. Manisha?
Thank you.
Whoa.
Well, thanks, everybody, for making it back from the break and the exciting debate. What we want to do today is talk about regulatory issues that are driving business decisions, and they oftentimes represent obstacles to growth in the industry. We're going to explore the business impact of regulatory changes and then conclude with a discussion on opportunities for growth in the industry. Just before we begin, I'd like to ask each of my panelists to introduce themselves briefly.
Thanks. I'm Pat Hickey. I'm the head of market structure at Optiver US. Optiver is a global proprietary market-making firm headquartered in Amsterdam with an office there that's trading European markets, in Sydney and Shanghai in Asia Pacific, and then in Chicago that's covering the U.S. markets, including the options exchanges.
So I'm Jim Toes. I'm with the Security Traders Association, STA. We are a trade association with 24 affiliates in North America, 21 in the U.S. and 3 in Canada. We've been around for around 83 years, and we're probably the only grassroots organization in the financial services industry.
I'm Joe Sellitto. I'm the CEO of Global Execution Brokers, which is the execution broker-dealer of Susquehanna Financial Group.
Great, thank you. So let's start out with what's kind of most recent coming upon us. June 15th is right around the corner, and the EU has not recognized the OCC as a qualified clearinghouse. Pat, maybe you could start us out and talk about what that means for firms.
So this issue strikes at the point that has been going on for a number of years now, that the lack of access to clearing services is really the point that's being brought up here. Banks being under the purview of either the Federal Reserve here in the United States or the European regulator are being pressed to honor certain rules about clearinghouses that they do business with. This issue has gone back 5 years, and it was made. It was brought out in the news with Chairman Massa of the CFTC actually coming to an agreement with the European authorities, I want to say 6 months ago or so. But that only covered the CFTC covered clearinghouses. It did not cover the OCC with respect to SEC-regulated securities, which includes equity options. So for us, with the clearing services being only made available from banks that are either U.S. domiciled or European domiciled, the worst case scenario of a clearinghouse not being recognized by the European Union leads to punitive capital charges on those banks that are actually clearing at the OCC, which then forces the banks to probably make a decision whether those punitive capital charges are even worth paying or not. So that just sets off a scramble for what limited clearing resources are left after that, and a waterfall kind of effect. So those are it's a troubling situation to find ourselves in, and we just encourage the regulators to try to work this thing out and provide the marketplace and participants in the marketplace like us a little more certainty in how this issue is going to play out.
Now, I know this has been delayed a couple of times. Do you expect another delay?
I think it's fair to expect a delay. And we can only hope that one is forthcoming and that it's announced very soon, it being mid-May now.
Yeah. Joe?
Yeah, I'm pretty sure that they've actually given a delay and pushed it out till December. And I think the central theme or the central issue is that the SEC has to submit their final rules or their CCAs, and that once those get approved, then the European Commission can consider their application for being a qualified central clearing agency.
Great, thank you.
And I think, the tremendous risk is that if they don't get qualified, that the additional capital that the European banks may have to put up may actually make them question, the business that they're in. And I think, the big risk there is that there is such a limited amount of GCMs or clearing agencies for U.S. listed options that there's, not a lot of places for all those customers to go. So it would be very detrimental if those rules didn't get finalized and if they weren't qualified.
Great, thank you. Maybe we can stay with you and talk a little bit about the bank capital rules. Their lofty goal is to, of course, reduce systemic risk, and, that sounds very great, but there's been a lot of critics of the Basel III framework and the Fed's proposals that they really don't address unique qualities of the listed options market. Can you talk a little bit about what the issues are here?
Yeah, well, the real issue is risk-weighted capital requirements and margin. And in 2008, the G20, in their effort to contain the systemic risk in over-the-counter options, came up with a one-size-fits-all solution, which is the current CEM method, which doesn't allow you to net positions and requires you to deal with each position individually and capitalize it individually. And, the options industry over the years had made tremendous strides in risk management and use of capital. And one of the key drivers for growth in the options business has been, compression of the spread. And part of that, in addition to the technology and the risk management, is efficient use of capital. And, now that is at risk. And so the industry is really trying to push for adoption of SACAR, which is a more risk-oriented capital requirement for use of capital. I think that's imperative, in particular because, in the U.S. Listed options market, a lot of the clearing firms are actually questioning whether or not, this is still a viable business for them to be in. And, all firms allocate capital based on returns. So when you have a certain return expectation on capital, and now you have to put up, significantly more capital to run that business, people start questioning whether or not that's a business that you really want to be in. So I think it's really important for the industry to get back to sort of a risk-based solution for capital requirements and margining.
And I know there have been several comment letters from the industry, including the exchanges, the Securities Market Coalition. Where do you see things standing right now?
What?
I said, there's been a lot of comment letters and work on the part of the industry. Kind of what is your take on it at this point in terms of
whether we're going to get relief?
Yeah.
I think SACAR is supposed to be implemented in January of 2017. So I think the push is to get that adopted sooner. I'm really not sure whether or not the regulators are receptive to a sooner implementation. I mean, I also know that there are other requirements that are being talked about in terms of, Cover 2. Right now, I think the U.S. is under a Cover 1, which means the clearing, the OCC has to hold enough capital to sustain, like their largest clearing member in a default. So that's sort of my take on it.
Okay, great. Pat, Jim, anything else you want to add?
Yeah, I think it again speaks to the relative attractiveness for a clearing firm to enter into this business, let alone stay in this business. Between the mutual recognition issue and then the capital requirements issue, whether it be SEM or SACR, and needing to reserve capital aside for these options positions that may not necessarily be based on economic risk that the positions have, kind of leads them to decide, well, it's just there's just more attractive businesses to make that return on capital. So assuming these issues get solved, though, there are some. I think there could be some light at the end of the tunnel. And first is if they can get it right, if they can get the capital exposure right, to going forward, have that be kind of the benchmark of how of what risk is based on, instead of, say, the traditional clearing fees and interest costs and things like that, but the actual use of capital that's being deployed and what the risk of that capital is. I think that could be a very positive for the industry. And also, there's another angle to this where all products are sort of being treated more equally than they ever have been. And what I mean is listed products versus OTC products. So the traditional model in the listed side is based on initial margin plus variation margin as far as what kind of exposures are expected or what kind of capital commitments are required from the participants to the clearing firms. But on the OTC side, it's always been based on credit. So if that model in the OTC side starts transitioning towards more of an initial margin plus variation margin model, then for the first time, some of these OTC products have always been more attractive because of that aspect of it. Listed products are finally on a little more level playing field than they ever have been. And what comes from that, I don't know. Maybe it's more participation from traditional OTC participants in the listed market, or maybe it's better access for listed market participants in the OTC marketplace. Not really sure how that plays out, but we think it has a lot of potential.
I think one of the unintended consequences of this one-size-fits-all model is I think that one of their objectives was to try to standardize over-the-counter options more to sort of rein in the risk and actually try to get more of those trades to take place in a central clearing agency. And I think just the opposite has taken place. By using CEM, I think more people are looking to the over-the-counter market to do trades rather than the listed market, and I think that's had the opposite effect of what they originally intended.
Great. Well, Jim, maybe we can switch gears a little bit and talk about what the SEC has been up to and from your perspective on the regulatory front.
That's great. I mean, I think maybe before we talk about some of their initiatives, I don't know how many people had a chance to see Steve Luparello up here yesterday with Gary Katz, but I think that that was very indicative of some of the progress that we've seen from the SEC of late, and also shows some of the work that still needs to be done. And by that, I mean, in the past 4 or 5 years, the ability of the SEC to pull in data has improved dramatically. Their ability to take that data and interpret it and come out with meaningful results through their Office of Analytics and Research has improved. But more importantly, the transparency that they are offering to the industry, transparency through their website, through their MIDAS system, that, here's the data that we captured, here's our interpretation of the data, issuing certain white papers and putting it out there for the public to view and then to send comments in. The transparency has increased dramatically with the SEC in the past 4 or 5 years. And on top of that, their willingness also to be accessible, as Steve was talking about, that is spot on. I mean, I can't tell you how their responsiveness to emails, to phone calls, their willingness to get on the call to talk about particular rules that are in various stages of their filing on it, and their ability to kind of to disagree without being disagreeable is a skill set that's truly appreciated. So for this group, I mean, obviously, as Steve talked about yesterday, a lot of their work has been on the equity side, and they have not. while they do realize that we are dealing in one virtual marketplace today, that liquidity flows from futures to equities to options and around, and they do realize that some of the decisions they make purely on equities does have impacts on other ones, they still need to be reminded that on a constant basis. So I think I would just encourage this group to really to find out who the point of contacts are at the SEC for your particular business and reach out to them and form relationships with them. As far as their agenda, their agenda kind of falls into like four buckets, and the first one is trying to create a regulatory regime for small cap companies. Obviously, this one size fits all people are pretty. It's obvious that it's not serving some of the secondary market needs for the smaller cap companies. So we're seeing things around not just the tick pilot that was talked about, but things around venture exchanges and Reg A Plus and so on. The other area is addressing market complexity. I think we all agree that the markets today are much more complex than they've been in the years past. Trying to help the industry get transparency, create some standards around market complexity, around Reg ATS proposals is another area that they're looking into. Trying to identify regulatory gaps. Registration of proprietary trading firms is an example of that. Trying to consolidate audit trail is another big one in that area. And then the last one is just around operational capabilities. So they're constantly looking for like those single points of failures, trying to address them before it gets to be a problem on it. So those are kind of the four big categories that all their decisions and guidance falls under. But just to go back to the original point, we have a regulator here who is transparent, who is being very responsive, and is open to hearing directly from the industry. They are surrounded. They're constantly getting input from attorneys. They're constantly getting input from maybe market structure folks. They really want that unfiltered access, and they can't encourage you enough to try to go back to your firms and to form a relationship with somebody there.
And I think they've been pretty clear in saying that, it's not their job to determine what the market structure should be, but rather than to deal with, rule filings as they're presented and to hear from the industry on sort of, their support or lack thereof of those rule filings, and then sort of to do what is in the scope of the act that, enables them, to either approve or disapprove.
Mm-hmm.
Yeah, I would agree. I mean, I think the response to August 24th is a good example of that in terms of data-driven analysis and reports they came out with, which didn't actually give a lot of conclusions, but gave a lot of food for thought. So I see that too. So we talked about sheep and wolves. Let's talk about cat. One of the initiatives that Jim mentioned is consolidated audit trail, and it's been going on for years. In 2010, it was first proposed, Rule 613. It was then adopted, approved, and then it was charged. The SROs were charged with coming up with an NMS plan. So that plan just got noticed for comment a few weeks ago in April. And one of the important things about CAT is the exemptive relief that was granted in March. And what that exemptive relief said with respect to options market maker quotes is that market makers would not be required to send options quotes to the CAT. Interestingly enough, if you read the CAT filing, it does ask questions about whether or not commenters agree with that exemptive relief as granted. So I think it may be still an issue worth commenting on just to show your support. But, other than that, why should we care about CAT? Maybe, Joe, you could start us?
Well, I mean, we care about it because it's here and it's moving forward, and we have to be compliant with it. There's a lot of cost involved in it. Nobody seemed to sort of blink at the implementation cost, which, from what I know, is around $5 billion, and the sort of maintenance cost of it is also very high. I know we were extremely pleased at the market maker exemption, but yet there's still a lot of work to be done. There's a lot of identifiers that have to be put on order submission and things like that. But I think that our hope is that CAT accomplishes not only what the original intent was, which is to be able to recreate the marketplace and draw some conclusions, that tell you why certain events take place. But, if CAT could ever be used as a forward-looking tool where, you can sort of mine the data and sort of predict outcomes I think that that's something that is probably beyond our expectation, but certainly in today's age of technology and big data, that's something that's a possibility.
Jim?
They're talking, just to try to put this in some type of scope here, they are talking about creating the second largest data warehouse in the world after the NSA. That's a lot of information that's being stored. They are talking about, in the world of cyber, that this is a single point where the information is all being aggregated into one spot. When you have companies like Google and Amazon, who are three of the final bidders on this process, and they are looking at this as somewhat of this is just my term, of a Trojan horse to try to get into the financial services industry, this is something that we should be paying attention to. When you hear the Google presentation and the Amazon presentation on this, they're already thinking about if we get the CAT contract on Monday, they're already thinking about what they can do with that information on Tuesday, Wednesday, and Thursday, about how they can put analytics around it, as Joe just talked about, maybe walk into a large bank and say, listen, we can do your compliance, we can perform your compliance functions for X pennies on the dollar, and we can do it better. So, I think the first question I think we have to maybe get comfortable with is, who do we want to have this information? Who are we more comfortable with having this information? Do we want to be an SRO along the lines of FINRA, or are we looking to do something in the area around a technology company like Google and Amazon?
Yeah, Jim, you bring up a good point. That once we get over what I would say the more simplistic levels of how are you going to comply and who's going to pay for it and what are the rules going to be around it, I think there's a huge question about governance in general and how is this going to operate? How is it going to run? What are the limits to the operators of it? What kind of say or participation do the people who are paying into it to kind of provide the data that makes up the CAT? What say do they have in how it operates or what changes can be made in the future? I think that all of these issues have to be vetted and considered and come up with something. Well, because this is the only chance that we have in this part of the process to make an impact.
I mean, and I think we're all concerned about the security and proprietariness of the information that we all submit, and need to be reassured that that's going to be protected.
Yeah, I think the governance issue is a very good one. I mean, CAT is not just going to be paid for by the SROs. The industry will also be paying for CAT, and how those decisions have not been totally solidified. It will be the operating committee that makes those decisions, and how the advisory committee interacts with that operating committee, I think, is a very interesting question that we probably want to weigh in versus how it's written right now. Okay, well, Jim, you also mentioned reducing market complexity, and I'd be curious, Pat and Joe, what you think about the role of the OCC in terms of harmonizing risk controls, clearly erroneous, and strikes.
Yeah, so when you consider the OCC, they've got on their plate right now, they have the mutual recognition issue, cross-border. They have the capital issues to consider and get right. And those two issues are 1 and 1A in our eyes. But assuming these get resolved in a responsible, forward-looking way, there's a real opportunity behind that for OCC to kind of take a bigger leadership role than maybe what they have in the past, as far as coming up with principles of how the rest of the market should operate, and issues of harmonization of risk controls or rules like erroneous trade, penny pilot, strike ads, things like that, where the industry hasn't been able to kind of coalesce around what makes sense with respect to these issues that might make that would be good ideas going forward. So we're of the view that controlling for operational risk is something that the entire industry can benefit from, and where is that best? Where is the apparatus for deciding what is best for what the framework of such rules around harmonization of those things might be? it's worth considering OCC.
Joe?
Well, harmonization has certainly been the mantra of the committee that I chair at SIFMA. And, I think a lot of people in their desire for harmonization look to OCC sort of to be the cure-all and the solution. They've taken a leadership role in a lot of the principles for risk management, whether it's kill switches or other, controls. The exchanges were way out in front of thinking about risk management, whether it's for market makers or order flow providers. I think that sometimes, our expectation that OCC, is the answer on every harmonization issue is a little bit sort of out of place in the sense that there's a lot of competitive issues that the exchanges deal with, and trying to force the exchanges into sort of a one-size-fits-all solution, maybe from a competitive standpoint, might not be the right solution. But I think that there certainly are issues that are not of a competitive nature, whether it's providing a theoretical value, which is one of the issues that's sort of left on the table with obvious and catastrophic error rule. I think strike harmonization is something that, could be domiciled in OCC. I mean, I think part of the problem with that is that the weekly rules are exchange rules, and I think somehow those need to be added, to the OCC strike rules. But so I think it's appropriate in certain circumstances and better left to the exchanges than others.
I mean, I would say as someone who was mostly on the equity side here, and looking at the options world, I think the relationship that you as an industry have with your central clear, with OCC is a unique one, and it is and I'm not just saying this because obviously buying dinner and drinks for me tonight, but this doesn't exist on the.
Somebody did say that.
Yeah. This doesn't exist on the equity side. I mean, if there was some type of a groundswell of a desire to do something on the equity side around market structure, anything, the idea of maybe going to DTCC to help to have them help facilitate it through an organized effort or some type of a task force, that I don't hear that. I don't hear it at all. And while I agree, sure, listen, they can't cure everything, but the role that they're playing and the relationship that you have with them, I think as an equity person, I think is a very positive thing, and I wish that we had something like that on the equity side.
Yeah, no doubt. It's just an opportunity at this point, I think, and a lot of details have to be ironed out. But if you take for us as a market maker participant, and to see that there's something north of 800,000 strikes that exist in the options universe right now, when only, let's say, less than 10% of those even trade or have some kind of significant open interest, all that represents is to further complicate the relationship, to have an obligation in most of those strikes as a market maker to provide quotes. It's just an operational risk for us to kind of provide a quote in an option that has no chance of trading. So to come to some kind of conclusion of what the right size is for where the industry should have to get to, and then for somebody, and this is my hope here, that the OCC comes along and says something like, here's the parameters or the principles that we have around strike listing. Whatever you guys want to list, go ahead, but this is all that we're going to clear. Like that I think that would significantly change the conversation overnight with respect to all the exchange rules and in a positive way.
Yeah, and I think a strike delisting.
Yes, delisting would go hand in hand with that.
Right.
Well, great. So, we had a chance to hear the market structure debate earlier, and I'd be interested as we think about the business impact of some of these regulatory changes and market structure changes, how this group feels about pilots. And, of course, the penny pilot has to be mentioned every panel, so the penny pilot has yet to end. But how does this group feel about the use of pilots to test market structure concepts? Maybe we can begin with Jim.
I mean, listen. It's. I think that there are good ideas and good execution, and sometimes when you get a bad execution on a good idea, the outcome is not always good. It makes the good idea look like it was not a good one. So, I mean, we're in a. If you're in the camp that decisions on changing market structure should be based on empirical data, then the next sentence is, if you're looking to do a market structure change and there is no empirical data, then a pilot is a good way to capture the data to figure out if you want to make the change or not. That's a good idea. And unfortunately, I'm hard pressed to look back and find a pilot program that was done, that achieved what it was hoping to achieve, and then now has either resulted in something that was permanent, turned off or turned on. So it's really. I still believe. I think, I still believe in the idea that pilots are good, but the execution on them leave a lot to be desired. And the one that the equity folks are going through right now, which I don't know if I agree with some of the comments before, that's going to have a spillover effect into options, because it tends to be the smaller cap companies, like $3 billion and under. So I don't know how many of them really have options on them. But regardless, I mean, this, what started out as a simple pilot for one group, a couple of securities, and what it's morphed into, the complexity is just not. It's not good. So it's the cost benefit was something that was brought up on the last one. There was the cost for doing this tick pilot on the equity side. That money it will not be recouped ever. I don't think so. That's kind of a general feeling on.
I mean, by definition, a pilot has an end date. Mm-hmm. And I think part of the problem that we get into with pilots is that the conclusion, or what the sort of end game is not determined when, the pilot's initiated. So, and then we just keep renewing it, and it just takes on a life of its own. And so I think if there was a better defined objective with the pilot within a certain time frame, I think we would wind up with, I think starting things in pilot phase is a good thing, because, that's the period of time where you really sort of collect the data and analyze it and can draw conclusions from empirical data. But I think you need to start out in understanding what the objective of the pilot is, and put some sort of time frame around when you're going to draw a conclusion from that.
Do you guys know how? I heard something quoted about how many open pilots there are at the SEC right now. Do you know that number?
Yeah, I don't know the exact number, but it's a lot.
I want to say it was on the order of 75.
I would. Yeah. I have no idea. If you're off, you're only off by maybe 10.
At least.
Yeah. So.
Again, it just kind of goes. Are they a good idea? Yeah. So is it? Have we seen a good execution on one? I don't think so.
So the other regulatory initiative that was discussed yesterday was the Department of Labor's fiduciary rule. And while it was, definitely a win for the best interest contract exemption to no longer have a restricted asset list, an asset list that did not include options, there's language in the filing that talks about some of the need to demonstrate that if you are choosing securities that were not on that original list, that you would have to have maybe a heightened level of supervision. So I guess my question, maybe starting with Joe, is, while it's a big win that asset list went away, do you still have concerns about fiduciary?
Yeah, I think everybody does. Almost everyone I talk to tells me that they're waiting for the lawyers to figure out what it all means. I mean, I think everybody is happy that options were not, were exempted from it. I think there's a lot of concerns around implementation. I think one of the major concerns is around educational effort and how much, education can be provided within the context of that rule. A lot of other people I talk to are concerned about the sort of even, mentioning of the word derivative and whether or not that conjures up giving advice or not. So I think the jury is out on actually, what it means and what you can do and can't do. I think there's a certain sense of relief that options were exempted from it, but I think that there's a lot, that we still need to know about it, and I think most people are waiting for their lawyers to instruct them on what they can and can't do.
Jim or Pat?
I mean, listen, the panel that was here yesterday talking about it, that was an enormous win to get that carved out and to have it excluded from it. It is sad to think that the amount of time, money, and resources that was spent by the industry to get options not included in it, it's a win to not be hurt. And unfortunately, that's just the world that we kind of work in sometimes down in D.C. But that was an enormous win to have it pulled out, given the momentum that was behind it and the players who were at the table. This is Department of Labor. This is different than dealing with the SEC and Treasury Department. So this was a lot that was very impressive that they were able to get it done.
Yeah, so if you go back a year or two, I don't think I ever expected to have to be the in-house resident expert on Basel III banking regulation, cross-border negotiations between the European Union and the United States. Now we have the Department of Labor and getting inside baseball and what they do. There's the IRS with the tax law change around foreign dividends. And the list goes on, and it's costly to our firm to have to kind of juxtapose to those types of issues that are kind of outside the scope or the purview of our business, but yet they dramatically affect what the outcome is going to be for our overall business if it doesn't go right for us. So it adds the complexity, which adds the cost, which adds to wider spreads, and investors pay for that, which reduces their confidence in the markets that we're showing, and it just leads to bad things.
Yeah. I mean, I don't think I'm an expert in any of those things, but I certainly have learned a lot in the last week in preparing for this.
Well, before we talk a little bit about the opportunities, we'd like to open it up for questions on these regulatory issues. So, questions from the audience?
Did we plant any questions?
If there's no questions, I mean, one of the things that I just want to add is, with all of the sort of regulatory headwinds that we're facing, and in particular, the capital issues are really important because they really have an impact on the quality of the market out there. And, everybody is talking about how, there's sort of what happened to the growth in the business and why a market's wider and auctions and all of those things. And, all of these things affect the quality of the market out there. As market makers, when you're, the GCMs pass these costs on to their customers. And as your costs go up, that all sort of gets baked into your model and has an impact on the amount of liquidity you provide and the quality of the market that you provide. And at the end of the day, we're all concerned about retail customers and retail customers, getting the best prices available in the market. So, I think that getting some satisfactory solutions to this is one of the things that sort of may be able to get us back on a more sustained growth path than we're on now.
We talk about, a lot of the cost issues, and the way I think we wanted to, end our panel was on a more positive note in terms of the opportunities. So, outside of these regulatory drivers that we've been talking about, where do you see opportunity within the industry?
I think there's opportunity everywhere. When you think about it, and we have probably one of the sort of slowest recoveries, in a long time. We have consumers that really aren't spending. We have asset managers that are underperforming. We have tremendous regulatory headwinds. We can go on, and yet we're doing pretty good. And so if there's sort of any improvement sort of in GDP or any relief from the regulatory burdens, I think there is a lot of opportunity to get back sort of into the growth scenario that we experienced pre-2008. I think one of the particular areas of opportunity is sort of in sort of package option products. I think Morningstar last week came out and sort of recognized, some of these option strategies and options, whether ETFs or mutual funds. So I thought that recognition was important. I think we'll see more of that. I think there's tremendous, growth opportunity, in Asia. I think as a product, options is still a tremendously underutilized, tool both for retail investors and institutions. And certainly, the educational effort, goes a long way in enabling people to adopt, the use of options. But I think that, somebody earlier said that options is still in its infancy, and I'm not sure it's in its infancy, but I think it's, still a fairly new product that still has a lot of penetration potential.
Yeah, no doubt. We talked a lot about the things that are kind of threats, I think, to our industry if they go the wrong way. But there's also the other side of the coin that says, what if they go the right way? What if they are at least resolved in a responsible and fair manner to allow for us to kind of build in what the costs are of whatever the regulation is, and move on to the next thing of how we can improve upon that. All we've talked about, or that list we kind of showed, is just another cost, as Joe mentioned, which absolutely does get baked into our model, and it's kind of an implicit tax of compliance with the rule that slows down GDP in general. So if there's a way to get beyond that and to start talking about more efficient ways of getting the principle of the sound regulation done without the excess cost maybe that's out there being talked about, then that can help to drive down spreads, better experiences, and it leads to a positive kind of momentum to the whole thing.
I guess our industry is, when you think about like the massive restructurings that have gone on in the aftermath of 06 and 07, and it's just really hard, I think, for firms when they're trying to restructure themselves to adhere to a Dodd-Frank or a Volcker proposal. It's hard to be restructuring and at the same time trying to find new businesses to get into and to grow certain other business areas. And I think our industry we do one or the other. It's very hard for us to do them both at the same time. So in some ways, I think where I do get optimistic for our industry at a high level is that many of the restructurings that have had to take place at the larger firms are in their later stages, and once it has been completed, and once the visibility on some of these, because the worst thing also that we can't stand in our industry is not knowing. So some of these rules are kind of coming to their final end. Some of the restructurings are coming to their final end. And so there isn't a certain level of optimism here that when these things get to their conclusion, that the growth and the opportunities will come. And to Joe's point, I do think that when that day happens, and it will happen soon, that everything at that point, because we've been able to survive these past 7 to 10 years, what that does to the bottom line, it should flow down to the bottom line.
Yeah, I think one of the problems is you're trying to regulate the risk out of the business. Yeah. And business is risk. That's what people do. They take risk and they analyze risk, and you can't, I think regulation has its place, but I think sort of the overreach and sort of, the capital rules is one example of, trying to contain the systemic risk in one area and it, restricts the growth in another area, and, trying to take the risk out of whether it's use of options for retail customers or trying to take, the risk out of anything. You get to a point where you can't walk anymore because you're so restricted, and it's hard to grow a business that way.
Mm-hmm. So I'll give one last chance for comments or questions. We've had an opportunity to talk both about the obstacles and opportunities for the future of the industry from a business and regulatory perspective. Any questions for my panelists?
You all mentioned how difficult it is to develop the knowledge for so many of these rules and regulations that are coming upon us faster and faster. And I think everybody here would benefit from understanding where you're getting your information from. How do you accumulate all the information on all the regulatory changes, both here in the U.S. and globally?
USA Today. No, it's literally dozens and dozens of conversations with other participants that may be better placed than us in a certain issue or aspect. Law firms, lobbyists, other competitors, what they're seeing in the marketplace, like how can we work together to kind of resolve an issue that we don't want to compete on at all. That's just a lot of talking and listening.
It's true. I mean, to your point, a lot of this stuff is so nuanced, and the amount of people out there that really have the skill set or the knowledge of these rules. It is a narrow universe. Having said that, though, there are a lot of smart people in our industry, and information is able to be shared rather easily. And the lobbyists, to Pat's point, these, I know, people have this connotation about lobbyists, that they're just down there trying to set up meetings and so on. They play a very big part on the education. And granted, at times it may be education with the point of view, but it is still education. And there are specialists, the lobbyists that we kind of come across down in D.C. that are specific to one particular asset class. Are very intelligent people, and their perspective is very different. It is of a global nature. So that is definitely one area that at least we try to tap into is are the lobbyists down there to try to understand, and a lot of them are law firms also to get the expertise on these complicated matters.
And Jim brings up a good point about the lobbyists being a critical sort of point of education. But more and more, it's falling on ourselves as participants to also be those educators of how the marketplace functions and why things work when it goes one way and why they break down going another way, and trying to show examples. Not even specific to any rule that we may or may not like, but just aside from all the rules, like this is how our firm operates as a business. And these are the things that we consider when we talk about risk. These are the things that we consider when we talk about software development. These are the things that we think are important as market structure issues without being provoked by, say, a rule that's bad or not. So we're starting to take that responsibility very seriously and think that maybe that's a path forward to sort of softening how bad some of these rules come out at first glance.
Yeah,
So, Gary, I think your question was, how do we all stay on top of all of this sort of deluge of rule filings and information? And I think most of us have a distribution process internally where, people sort of scan for all of the rule filings as they come out, and everybody sort of has a different channel to monitor. And all of those rule filings and information are distributed sort of to different business owners and segments of the business, and I think that's one of the mechanisms. But I think a lot of people also rely on, whether it's STA or SIFMA and their participation in a lot of those organizations and on their committees to be aware of and to get interpretations on a lot of the rule filings. So I think that's how a lot of people, stay on top of it.
Well, great. I'd like to thank our panelists. This was a very interesting discussion. Thank you.
Thank you. Yep.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.